Well, markets point to muted action after another volatile week on Wall Street, and our next guest says the economy's soft landing is what's really behind the weakness so far this year. Joining us now is Daniel Morris, BNP Asset Management Chief Market Strategist, and with us for the hour, of course, the one and only Cory Johnson, Epistrophy Capital Chief Market Strategist and host of the Drill Down podcast. Welcome to you both. Dan, start with you here on the markets. And I thought, Dan, your comments are interesting. You're looking at the market action this year, Dan. You say, in your opinion, this has really been much more about the macro. It's about the slowing growth more than the tariffs, Dan. Walk us through that, because I can't tell you that we got a lot of strategists on. Really, the word so far we hear over and over again, focus, the attention has been on tariffs. Why do you say that?
Well, I think that misses the point, and that's important because if you're not analyzing what's really going on in the market currently, I think you then miss what might come next. So think back to what we thought was going to be the outlook for 2025 before the election, and the word we kept repeating over and over, of course, was soft landing. So that meant growth was supposed to slow. Inflation then would come back down towards target, and then the Fed cuts rates, and we were going to all be quite happy. Now, we perhaps got a bit distracted by what happened subsequently with the election. Of course, the market started pricing in what it anticipated as pro-growth policies from Trump. But we got to remember there's a sequencing effect here. If that happens, it's not going to be right away. You need time for these things to filter through for the economy. The economy is going to continue doing essentially what it was going to do. And I think it's that soft landing that we anticipated. So from that point of view, we shouldn't be surprised. That's what we thought was going to happen. And I think fundamentally, that's the key thing that's behind the market. Of course, tariffs come on top of that. But the key point, I think, is the soft landing.
But it is a softer landing than anticipated by many. I mean, you're looking at GDP forecasts that a lot of places are revising lower, and many are attributing that to the sort of survey data that we've gotten, the weakening sort of confidence in part.
Yeah, I guess I, again, kind of question the analysis that's going on there. So if we go back to the growth rate we had at the end of the last year, 2.8% if you look at core GDP. Well above trend. We expected that to go down, right? That's all part of that picture, towards 2-ish, let's say. So we're kind of going in that direction anyway. I think some of the numbers that you see in the calculations of the GDP now are a function of the surge in imports you had ahead of the tariff. So that does have a mathematical impact on the GDP calculation. But if a lot of those imports just end up in inventories, you'll more or less see an offset in the GDP calculation when the figures come out. So I still think we're looking at a 2-handle for GDP for the first quarter. We'll see. Not an economist, no predictions on what's going to come out.
But if we get more layoffs at the Fed, right, we see consumer confidence concerns spiking. We see concerns about potential inflation spiking. When just that concern alone pulls back, see the consumers spend less.
Conceivably, I mean, you always talk about the feedback loop. I just want to highlight one thing on the decrease in consumer sentiment, because if, to the degree that we went back to Trump 1 to say, okay, there's my playbook, everything's going to go the same. And one thing you certainly saw during the first Trump administration was both consumer confidence and business confidence both shot up. And both of those back then stayed quite high. What's been different this time is that business confidence has actually, despite tariffs, right, still quite high, but you've seen this drop in consumer confidence. And then if you just read the headlines, it's, oh, well, tariffs are dampening consumer confidence and so on. I kind of question that assumption because what you've also seen, and I would argue more importantly, over the last four months, is an increase in headline inflation on a monthly basis. So people are saying when they go into the stores, gosh, prices are going up again. That made me really unhappy last year, and it's making me unhappy again. So I think that's, again, a key driver.
Dan, with all these cross currents, I'm just curious, have you made any kind of meaningful changes to your earnings outlook this year or held steady there?
Well, I think we pulled back because of this. If you had that initial assumption of, hey, gangbusters, everything's going to be great, we were overweight U.S. equities, honestly, I think like most people. But when we started to have some doubts about that outlook, we pulled back. We're kind of hugging, neutral around now. We're in a transition period, which we appreciate. We're not quite sure what we're transitioning to be honest. So we want to wait, try to have a bit more clarity before reallocating. So neutral now, but anticipating to move back into equities at some point.
And Dan, as somebody who is based outside of the U.S., you're based in London, I'm especially curious to get your take on this emerging piling into European stocks, for example. I saw a chart today that Bloomberg's Joe Weisenthal put out where he looked at the ratio of U.S. stocks to the rest of the world using a couple of ETFs. And effectively, U.S. stocks have just dominated. They have been the place to be for so long now. And now we've got this little bit of a blip down in that ratio. Do you think there's some staying power here, or do you think that, the U.S. as the place to be is going to reassert itself?
Well, you see that if you just think about your benchmark allocations, take the MSCI World Index or All Country World, the U.S. is 65 to 75% of that index. And, you think about the other opportunities that are out there in the world. We've seen that now in Europe. We've seen that now also in China. So I think it's probably a healthy reallocation, because even if, in retrospect, honestly, I think the overweight that, again, most of us had immediately after the election was the right one, so to speak, or it made sense at the time. I think the healthy aspect of the markets today is, even if you might still think U.S. equities are going to outperform over the long run, you probably feel a bit better about the outlook for Europe, about the outlook for Japan, about the outlook for Europe, for China. So I think a bit more of a balanced perspective, and therefore, yeah, you should probably have a bit more of a balanced asset allocation.
Is it what the moves we're seeing right now about U.S. investors looking to Europe, or is it about Europeans keeping their money in Europe and saying maybe less U.S.?
Well, I'm not sure exactly on the data, but it would ideally be a bit of both. Now, of course, any country has home bias, and given the size of the U.S. market, you kind of wonder how many people really are going to be willing to look abroad. But again, from an asset allocation diversification point of view, probably a healthy thing.
Your expectations, Dan, for the Fed this year, what are you telling clients?
Well, this is interesting. If you look at Fed forecast for Fed funds at the end of this year, so we're now back down about around 350 the last time I checked. As it happens, that's more or less exactly where we were before the election, when we thought we were going to have a soft landing. So you had the big sell-off in expectations, thinking it was going to be more growth sooner. We're now kind of back to where we started. So I think that those two cuts or so, 350 or so, reflects, again, what I think is that soft landing outlook. No longer that risk of overheating that we had initially, but also very much not a recessionary forecast. So, if the data continues to come in line with that expectation, then yeah, it seems reasonable to me.
Dan, thanks for coming in.
Thank you.
Thanks. It's good to see you in person.
Likewise.